Okay, let's go.
Stare solely at a 3-minute chart, and you're looking at statistical noise. Price whipsaws violently in a vacuum of chaos. But zoom out, and that chaos evaporates. Those erratic 3-minute spikes merge into a single, highly predictable lower wick of a massive daily candle. High-probability setups never actually originate on the time frame where you pull the trigger. The entries you take on a 3-minute chart are simply the terminal endpoints of a much larger sequence. To eliminate the false signals generated by lower timeframe noise, we have to chain technical logic across multiple, distinct timeframes. This diagram outlines the fractal alignment matrix. We construct a cascading sequence that filters intent from the daily chart, down through the 4-hour, refined on the 1-hour or 30-minute, and finally executed on the 5 or 3-minute layer. True institutional edge does not come from isolating patterns on a microchart. It is derived entirely from strict cross-timeframe alignment. The entire matrix is built on one absolute starting point, the daily anchor. This sequence illustrates what we call a daily C2 profile, characterized by a structural reversal into an expansion. Notice the behavior at the bottom. Price drops below the previous day's extreme, trapping breakout traders and capturing engineered liquidity before aggressively reversing upward. This is the alternative high-probability daily structure, the C3 profile. Instead of a deep sweep, it forms a higher low, displaying clear trend continuation and expanding upward without testing the previous extreme. Compare these precise structures to a chaotic day, a C4 profile, where the daily candle closes inside the previous range without clear expansion or sweeps. The rule here is strict. If the daily profile does not match a clear C2 or C3, the probabilities collapse, and the only correct execution is to sit out. Without the daily anchor setting a definitive directional bias, any complex lower timeframe analysis you perform becomes functionally useless and structurally doomed. Once we confirm the daily C2 or C3, we drop to the 4-hour chart to profile the internal substructure of that daily anchor. Here, we apply cross-asset correlation to validate the move. We are specifically looking for cracks in correlation, often referred to as SMTs. This tracks two correlated assets. As price drops, one forms a lower low while the other holds a higher low. That divergence isolates institutional strength. Marking the specific higher low on the stronger asset pinpoints the exact crack in correlation. We then evaluate the 4-hour candle forming at this key swing point. We must ask, is this candle expandable? If it taps a major opposing key level precisely at its close, it may lack the room to continue. We can further measure the strength of the move by observing the gaps. The correlated asset that leaves a clear fair value gap during its expansion is mechanically the stronger pair. We do not use these cracks in correlation as standalone entry signals. They are forensic tools used solely to confirm the institutional intent behind our daily profile. We take that validated 4-hour framework and step down to the 1-hour or 30-minute timeframes. This layer is where we establish absolute invalidation parameters, particularly for a C3 continuation setup. Look at this 4-hour expansion candle. We map a strict horizontal boundary right across its 50% equilibrium line. A valid continuation requires lower timeframe retracements to respect that upper half. The 30-minute candles can dip, but must bounce cleanly upward off the line. If the price breaches that 50% mark and closes deep within the lower half of the preceding structure, the matrix fails. Watch the 30-minute candles breach the 50% line, aggressively filling the underlying gap. That red interface signals a complete structural failure of the continuation. This specific breach dictates that the continuation protocol is dead. The bias immediately shifts from a trend continuation to a deep reversal scenario. The 50% equilibrium rule provides a mechanical, emotionless boundary. It stops you from getting trapped on the wrong side of momentum when the institutional narrative changes. With the macro direction secured, we reach the final stage, the 5-minute or 3-minute execution layer, usually analyzed during specific windows like the 9 a.m. New York Open. This microlayer is strictly off-limits unless the preceding daily logic, 4-hour substructure, and 30-minute validations align perfectly. When aligned, we look for the execution trigger, a V-shaped change in the state of delivery, rapidly breaking local structure upward and leaving a distinct gap. We do not buy breakouts. The order is placed exclusively on the retracement back inside the gap. Protecting that entry requires strict mechanical stop-loss placement. The stop-loss is placed tightly below the body of the V-shaped structure. If price violates this exact level, the micro-premise is invalid. For targets, we aim for the unmitigated liquidity pools previously identified on the higher timeframes, naturally producing an asymmetrical risk-to-reward ratio. The micro-execution layer is simply where you pull the trigger. The actual decision to trade was made layers above this timeframe, long before the entry. Consider a high-probability expansion in an index like the Nasdaq, where the assets decouple correctly against the broader market. This stack visualizes the exact sequence: a daily continuation on top, validated by a 4-hour correlation crack, supported by a 30-minute hold, ending at a 5-minute entry gap. The explosive micro-movement is a physical reaction to macro intent. Momentum cascades downward, dictating the expansion. Most retail traders make a fatal operational error. They attempt to trade that bottom layer while ignoring the misalignment of the layers above it. Executing on a lower time frame without macro support results in structural collapse. It forces invalid trades, traps positions, and guarantees a steady bleed of capital. You must treat the matrix as a rigid checklist. If the logic does not align cleanly from the daily chart downward, do not trade. High-probability trading is an exercise in structural patience. You wait for mechanical, institutional alignment, rather than hunting for patterns in the noise.